We're going to talk to Jeremy Siegel. He's a Wharton professor of finance. He has done a lot of work on the basis of super boom predictions, and last month he told us that the S&P 500 could see returns of more than 10% in the second half of the year. Obviously, that prediction is looking tough right now, Professor Siegel. We appreciate you joining us. What do you think this, the last couple of weeks were bad. Today is looking pretty scary and much worse, with down volume here at 1.7 billion shares. The up volume, only 1% of that. Is it all because of the downgrade?
No, it isn't all because of the downgrade. It is the only way I can see the stock market being justified is fear, strong fear of a double dip recession. There's no other way. Look, we saw the treasuries rally to new highs on this downgrade. It's got to be much more than the downgrade, or we wouldn't see the action in the government treasury bonds that we have seen. So unless you think there's going to be a double dip, right now is, again, an extraordinary opportunity. We're selling, I think, last time I calculated, 11 to 12 times this year's earnings. And again, people say, well, maybe these year's earnings won't come about, but we already have 2 quarters under our belt that exceeded expectations. So, what again, you need an absolute devastation to get down to these levels.
Well, is this the kind of devastation that could trigger real problems with the economy? Because I've been talking to traders today who've been saying, you know what, there could be margin calls here as one of the reasons for the acceleration and the decline throughout the day. There could be baby boomers who have just had it and are jumping out, those who are still left in the equity market. Could drops like this, and today obviously not the first day of drops, could they bring a recession on, Jeremy?
Well, all the time. The stock market is one gauge in consumer confidence. And so when the stock market goes down, we always get some drop. We have to accept that drop. Again, we're still above year-ago levels. We are still, I think 70%, 75% above the March 2009 low that we reached. Earnings this year is, again, in absence of a total a collapse of the economy, are going to be at record levels. Interest rates are at record low levels. So, the dynamics are such that fear and panic, in my opinion, have just overtaken reason in pricing today's market.
Well, that's interesting. Hey, Jeremy, take us back to March of 2009. Our guys over at Bloomberg News, they crunched some numbers, and they say that the S&P is down about 14% since July 22nd. They say that's the worst drop in the same time period since the 11 days ending March 3rd of 2009. Now, we know what happened right after that March 9th, 2009 low. Do you feel anything similar? You called that low. Do you feel anything similar to what we're going through today to where we were back in March of 09?
But one has to remember, March 2009 was 60% below the previous high, which was reached in October of 07. We right now, I think I calculated, are 20% below that April recovery high. We don't even qualify yet as a bear market. It's still in correction mode. Back in March of 2009, we were ending up in the worst bear market in 75 years. So I think we're nowhere near as in bad a shape by any stretch of the imagination, even though we've had a precipitous decline, I know, over the last week and a half. Selling climaxes are often what ends any bear market, and hopefully it will end this one.
Jeremy, let me ask you, though, are the fundamentals different? When you look at Europe, when you look at the United States, people may disagree with the S&P and maybe in terms of the politics side of it, but a lot of people say if you look at the U.S.'s finances, they weren't wrong. So if you look at Europe, you look at the U.S., you look at the slowing U.S. economy, it's hard to ignore that fundamental tough picture.
The slowdown in the economic growth is certainly something that's very, very discouraging. But I urge people, if anyone thinks this is like the 1930s, to look at the economic data of the 1930s. GDP was down nearly 25%. The unemployment rate, and it was measured much more conservatively back then, was 25 to 30%. It would be 40% on the way we calculate it today. So we are not in that mode at all. We have stemmed that panic and decline. And I remember in March of 2009, a lot of people were saying we are tumbling right into that depression. I think the last 2.5 years have said, no, we're not.
What do you think we need, Jeremy? What do you think we need, Jeremy, to restore confidence? Do we need to hear more from Ben Bernanke? Clearly, the president's speech didn't help.
I think the Fed should act tomorrow. I think maybe not QE3. That's maybe a little early. There's lots of things they can do. I've been advocating lowering the 25 basis point interest rate that they pay on reserves. With interest rates so low, there is no incentive for banks to move out of that reserve base. We need to incentivize them to move some more money. That's what the Fed is supposed to do. There are measures they can take. The market will be very disappointed if we get the same unchanged directive, I think, and it's coming out tomorrow. Am I right?
Yes. Yes.
I mean, at 2:15, the market is looking for something, and I hope the FOMC and Ben Bernanke come through with something for us.
Jeremy, just got a few seconds left here, so let me ask you, would you be advising investors to buy right now or not yet? We've got to wait and see where this one settles.
I mean, if you're a long-term investor, you know, I'm virtually certain you're going to be very happy with buying now. No one can say where the bottom is going to be in the short run. Could we have another 5%? Yes. Could today be the bottom? That's possible also. But if you're geared towards long-term values right now, you're rarely going to get the opportunity to buy stocks so cheap.
All right. Hey, Jeremy, thank you so much for joining us. Jeremy Siegel there, professor at Wharton. We are going to